Okay, let's just get right into it. You know the feeling, right? You look at a screen and it's just a sea of numbers. Green means you're a little richer, red means you're a little poorer. And you have absolutely no idea why. It feels like this secret language that you were never taught, but somehow everyone else seems totally fluent.
And then it gets personal. You hear that your coworker, the one from accounting, took a wild guess on some stock, made 50 grand and just quit. You hear about it, and man, it just feels like a punch to the gut. How did they know? What was the secret?
And now you look at his Instagram and it's all motivational quotes from a beach in Bali, while you're sitting there still at your desk staring at that same confusing screen of red and green numbers. Maybe you even bought the same stock he did and somehow lost money. What's the difference? He got lucky. You didn't. So yeah, welcome to the stock market. It can feel like a giant casino where millions of people are betting their life savings on things they barely understand. But here's the thing. It's not pure chaos. It's a game, and it has rules. And today, we're going to learn the most important ones.
So first things first, what even is a stock? It's actually pretty simple. It's just a tiny piece of a company. If you own one share of Apple, you literally own a tiny microscopic slice of that entire business. A fraction of the profit from every single iPhone, every MacBook sold, well, a piece of that belongs to you. That's it. It's not magic.
Okay, so why do companies sell these little pieces of themselves in the first place? Well, it comes down to one thing: money. If they want to grow, build new factories, hire more people, they need cash. And they really have two choices. Option one, they can borrow it, take out loans, and be in debt forever. Or option two, they can sell off little pieces of the company, shares, and never have to pay that money back. Guess which one most eventually choose?
This whole process is called an initial public offering, or an IPO. And the company gets this huge pile of cash from investors right at the very beginning. But here's the really crucial part that most people completely miss. After that IPO, the company has its money. It's done. Everything that happens next, all that wild trading you see on the news, that's just people like you and me selling those shares back and forth to each other.
And that, my friends, is where things start to get weird. This is the part that feels like a casino, because a stock's price often seems totally, completely disconnected from what's actually happening in the real world. Let's break down why.
I mean, this is what drives people absolutely crazy. The theory is so simple, right? A company does well, makes more money, so its stocks should be worth more. But in reality, you'll see a company announce record-breaking profits, and its stock will just plummet anyway. Why? It makes absolutely no sense.
Well, it makes no sense until you realize one fundamental truth. Stock prices aren't about today, they're about tomorrow. Investors aren't paying for what a company is worth right now, they are betting on what they think it will be worth in the future. The entire market is just a giant voting machine, where everyone is casting their vote on what they think the future looks like.
And if you happen to vote correctly, oh man, the results can be absolutely staggering. Just look at NVIDIA. Back in 2014, its stock was about $4. Some investors voted, they bet, that AI was going to be huge and that NVIDIA's computer chips would power the whole thing. They were right. 10 years later, a $10,000 investment would be worth over $2 million, a 22,000% return. Not because of what NVIDIA was then, but because of what everyone voted it would become.
But this constant betting on the future also creates these massive collective mood swings. The entire crowd can get super optimistic and then, in an instant, become absolutely terrified. This leads to these huge cycles of booms and busts, which we can understand by looking at two animals, the bull and the bear.
A bull market is when everyone is feeling good. Optimism is high, the economy looks strong, people are buying things, and prices just climb nice and steady. But when that mood shifts, fear takes over. Everyone rushes for the exits, they start selling, and prices fall hard and fast. That's a bear market.
And there's this old saying that just perfectly illustrates the difference in speed. It's that bull markets climb up the stairs, but bear markets jump out the window. That slow, steady climb of a bull market can get completely wiped out with terrifying speed. You can lose in a few weeks what it took you years to build. And that sudden drop, that's what we call a crash.
So here is a perfect little story of what happens when hype completely overtakes reality. Pets.com. Back in the dot-com bubble, their business model was, well, it was simple. They lost money on every single box of pet supplies they sold. Their mascot was a sock puppet. The hype was so insane they even bought a Super Bowl ad. And the result?
The company burned through $300 million and went bankrupt in just 268 days. It's the classic tale of a bubble bursting. Okay, so if trying to pick the next NVIDIA is basically impossible and betting on pure hype can lead to total disaster, how does anyone actually win this game? Well, the secret is you don't have to try and beat the game. You just have to join it.
So let's just ask the question directly. In a system this chaotic, driven by feelings and unpredictable bets on what might happen years from now, what is the actual strategy for success? How do you win a game that seems to make no sense?
The answer, believe it or not, is surprisingly simple. It's called the index fund. See, instead of trying to find that one winning needle in the haystack, you just buy the entire haystack. With one single purchase, you can own a tiny little piece of the 500 biggest companies in America. You're no longer betting on one company, you're betting on the entire US economy as a whole.
And why is betting on the whole economy such a good bet? Because historically, it has always gone up. I mean, look at this. The journey is pure chaos. You've got terrifying dips and wild swings all over the place. But the overall trend? It's undeniable. The data shows that the patient investor who just stays in the market, who rides out the chaos, wins.
But how do you actually force yourself to stay put during all that chaos? Well, you make it automatic. There's a strategy called dollar cost averaging, where you just invest the same amount of money every single month, no matter what. When the market is high, your money buys you fewer shares. But when it crashes, that same amount of money buys you more shares on sale, setting you up for bigger gains when it bounces back. It takes your own panic and emotion completely out of the equation.
And this strategy protects you from the biggest psychological trap of all, which is something called survivorship bias. You only ever hear about the one guy who made $1 million on GameStop. You never hear from the thousands of others who held on too long and lost their life savings. The winners are loud, but the losers are silent, and that makes it feel like everyone else is winning except you.
So let's just boil all of this down. If you forget everything else from today, just remember these 3 simple rules. Honestly, they are the only ones that truly matter for long-term success.
Here they are. Rule 1, be patient. Time in the market is so much more important than trying to time the market. Rule 2, be safe. Don't invest any money that you're going to need in the next 5 years. And Rule 3, my personal favorite, be lazy. The market almost always rewards doing nothing over frantic, panicky trading.
So let's go all the way back to your coworker in Bali. Yeah, he got lucky. Good for him. But luck isn't a strategy you can count on. Patience is. And over a lifetime of investing, patience beats luck every single time.